We're off.
Hi everyone, I think we're live now. Welcome to Lunchtime Live. My name's Jess and I work in the communications team here at Free Agent. I'm standing in for my colleague Adrian, who's currently on holiday in sunny California.
Jammy devil.
So hi Adrian, if you're watching, you're probably not, but hi anyway. This is our Chief Accountant, Emily Coltman, FCA. She is on hand to guide us through this webinar today. Oh, sorry, I'm a little bit nervous standing in for Adrian today. He normally does such a good job, so hopefully I can stand in his shoes just for once.
I think they'd be a bit big, wouldn't they, Jess?
Yes, Adrian does have larger feet than me.
Size of Adrian, great big man. I think we could both fit in his shoes.
So for those of you who don't know, we're Free Agent. We are online accountancy software for small business owners and freelancers. Emily here is our Chief Accountant, and we do regular live and text Q&As with Emily so she can answer your questions. So today is the 31st of March. We are coming towards the end of the tax year. So today's session is all about what you need to know and do as we get towards the end of this tax year. So we have 5 tips to talk you through, but we're also here to answer your questions. I can see we have a question already, which is fantastic.
Great.
So please don't be shy, pop a question in the Q&A chat button and Emily will do her best to answer it. But let's get started with Emily's top 5 tips. Emily, tip number 1, I believe, is about buying assets.
It certainly is, Jess. So if you're preparing your accounts to the 31st of March each year or to the 5th of April, then what you need to think about is whether you have any plans to buy any pieces of equipment for your business in the near future. So that might be a computer, it might be some new furniture. If you're thinking you're going to treat yourself in the not too distant future, my suggestion would be do that before the end of the tax year because you'll get the tax relief a year early. When you buy equipment for your business, you get tax relief on the cost of that asset or on some of the cost of that asset in the form of what's called capital allowances. You can use the capital allowances to reduce the amount of profit you pay tax on. So if you have any plans to buy a piece of equipment in the not too distant future, do it now, because if your accounting year ends the same as the tax year, which for many small businesses it is, you are actually going to get your tax relief a year early.
Great, thanks, Em.
That's okay.
And when we talk about treating yourself, we are talking about treating your business,
correct,
right?
Okay. Yes, correct. I suppose I'm thinking when I bought a nice new shiny MacBook Air a couple of years back, of course that was for my business, but it felt like I was treating myself because I had this wonderful, fantastic computer to work on instead of the big beat-up old PC. Sorry for swearing, Ollie. We don't have PCs in the office.
No,
I think Jenny had said something about she couldn't see.
Oh, right, okay.
On Slack.
Let's have a look.
Yeah.
Sorry to anyone who can't see us.
Yeah. In the meantime, Jess, shall I answer this question from Reese?
Yes, I think Jenny can see us now, so hopefully
good.
Everybody else
that
can see
good.
us. That's
great. Okay.
So yes, we do have a question from Reese. Reese is a sole director of a limited company. He works solely from home and has use of homes, that's electricity, broadband, phone and mobile phone expenses. His question is, does he need to fill in a form P11D and P11DB? And are there any other forms he needs to fill in for this year end?
Thanks very much, Reese, for your question. Well, whether you need to fill in a P11D and P11DB depends on a few things. A P11D and P11DB are forms that you would fill in if you are receiving non-cash benefits or reimbursed expenses from your employer. And if you're sole director of a limited company, the company's your employer, you're an employee. Certainly if you're drawing salary from the company's your employer. So is your company making available to you non-cash benefits? So that might be a company car, it might be private medical insurance, or is the company paying you back for expenses that you've personally incurred? Because one trap it's very important not to fall into when you're doing a P11D is to put expenses you've incurred on behalf of the company on it. It's not that, it's expenses that the company has paid you back for. So that might be the same as the costs you've incurred, or it might not. So just watch out for that. In your own situation, Reese, obviously it does depend on whether the company's paying you back, whether the company is actually your employer, as in are you taking a salary from the company, or is it just paying you back for expenses? Strictly speaking, if it is just paying you back for expenses, you should register with HMRC as an employer and do a form P11D. In terms of your mobile phone, a limited company, indeed any employer, can provide to its employees one mobile phone each, free of tax, and you don't have to report that on a P11D. So what that might be is if it gives you an iPhone or a BlackBerry or an ordinary mobile phone, whatever that might be, a company can actually provide each employee with one smartphone or mobile phone free of tax, and that doesn't have to go on the P11D. In terms of what other forms you need to do for the year end, Reese, that does depend on whether you're running a payroll, whether the company's paying you a salary. If it is, then you'll need to make sure that you do your month 12 RTI submission and answer all the questions about things like, do you have to fill in a P11D? Are you a service company? Have you been paid any money from somebody who's not your employer through your employment? Things like that. So you need to do that. Otherwise, it's going to depend on when your accounting year finishes as to what you have to do when, things like when you do your company's accounts and when you do the company's tax return. And the company's annual return, which is the report that talks about who the directors and shareholders are and where the company's based, that's always done every year on the anniversary of the company's formation. So that's not necessarily going to relate to the tax year. P11D and P11DB, my gut instinct is it sounds like you do, but I would just double check that with your accountant to make sure. Other forms, make sure you do get your last RTI submission in on time.
Thank you, Em.
Yeah, that helped.
Excellent, great,
Good.
and thanks for the question, Reese. Feel free to ask more, and if anybody else would like to ask Emily a question, just pop your question in the chat
Please
box.
do.
So moving on to tip number 2.
Yeah,
I believe this one's about tracking costs.
it certainly is. Yes, it certainly is. Again, if your accounting year coincides with the tax year, make sure that you've included all your business costs in your accounts. Why? Because if you miss out costs, your profit will look like it's too high. That means you pay too much tax. Bad idea. You don't want to hand over more tax than you have to. I'm certainly not advocating tax avoidance or tax evasion, but there's no reason for paying more tax than you should do because you've missed out costs. So make sure that you've tracked all relevant business costs. And by that, I mean, make sure that you've recorded everything that goes out of your bank account. Make sure as well that you've tracked everything that you've paid personally on behalf of the business, because remember, the business can still include those costs in its accounts. Remember, the business can still use those to reduce its profit that it pays tax on. So, for example, if you've travelled on business in your own car, or if you work from home like Reese does, or if you travel on business to visit a client, you go by train. Make sure that you keep track of all these costs and include them in your accounts. If you miss them out, not only could you risk paying too much tax, but also there's the possibility that you'll think your business is making more money than it actually is, and you could end up running out of cash faster than you expect, because what you expect you're going to have left and what you've actually got left are two different things. So just watch out for that.
Thanks, Em.
That's all right.
Good tip. So moving on to number 3.
Yeah.
Invoicing.
Invoicing, yes. Well, in common with the other two, this is something to think about if you're invoicing, if your accounting year rather is the same as the tax year. So in terms of invoicing, one important thing you need to do is to make sure you report all your income in the right accounting year. Now, if you're using the cash basis of accounting, that would actually be when you get the money from the customer. But if you're not using the cash basis of accounting, so that would be if you're a sole trader who doesn't use the cash basis, or if you're a limited company who can't use the cash basis, what you need to make sure you do is to record all the income in the tax year, assuming you're doing your accounts for the tax year, when you do the work. That's not when you invoice, it's not when you get paid, it's when you do the work. Those are the rules from an accounting point of view. So my recommendation would be to make it easy for yourself, issue the invoices straight after you do the work. If you've done part of a project, and the part you've already done is part that you're entitled to invoice for, send the invoice. Not only will that mean that your income gets reported in the right year, it'll also mean your client will pay you all the sooner, because they can't pay you without an invoice. I think we did a bit of research around this, didn't we, Jess? And it wasn't a firm conclusion, but it seemed to point quite clearly to the fact that the sooner you invoice after doing the work, the sooner you get paid. That was one possible interpretation of the results. So I would certainly recommend doing that, because for one thing, then you don't have to think about it again. You've done the invoice, you sent it, you can forget about it. For another, you stand a very good chance of getting the income into the right tax year. And for another, it also means that you're going to get paid, which has to be good news, yes. Oh, Anthony says hi. Hello, Anthony. Have you got a question for us? Please do pop it in if you've got one.
I think if it's the same Anthony who's popped a question on the event page,
Okay.
I think I may have Anthony's question already.
Oh, great. What's he said?
Anthony, or this Anthony or maybe a different one, asks, I am a sole trader and I have my trading address as my home address where I work from, but I've been renting a shared office off and on for the past 6 months. Can I claim on my tax return on the mileage to and from that shared office space, as it is not a permanent setup for me?
Oh, Anthony, that's a difficult one, because what you have to be careful of when you're a sole trader is that traveling to and from your quote unquote base of operations, to and from your base of operations from your home, you actually cannot claim tax relief on. The basic rule is you can't claim on home to work. So whether HMRC would see your rented office as your base of operations, even if that's a temporary base of operations, they might well say, no, you can't, because they might well say that their journey is in order to enable you to live at home, not to enable you to work at the office. But if you work also at home and the office is a temporary setup, they might say, yes, you can. It's not a clear-cut answer. And I hate to do this to you because I realise that people hate non-committal answers. So I'm really, really sorry. But unfortunately, the rules that HMRC lay down say that each case gets considered on its own right. So what I would do is I would have a chat with your accountant just to see what they think, if you've got an accountant. You could, of course, ring HMRC, but do remember they are, and I'm sorry to HMRC, they could be biased. They could want to steer you away from claiming the tax relief because it's in their own interest to get you to pay more tax. Sad but true. My own thought would be, if it's a temporary place, if you are also working at home, I think you've got a good argument to say that your home is also part of your base of operations and you're actually travelling between workplaces. It does depend on what you do, though, what your actual job is. So it's not a clear-cut answer. Probably if you're a client of mine, I'd want to discuss it in more detail. You may well have an argument for including it, but as I say, I'm just sorry I can't give you a definitive answer.
Okay, thanks, Em.
That's okay.
And Anthony, if that wasn't your question, or if it was a different Anthony's question we were answering there, please feel free to pop your question in the box.
Yes, please do.
Lovely. Okay, so I think we can move on to tip number 4.
Let's do that.
And I believe this one's about ISAs.
It certainly is.
You need that.
What, the water, or to keep calm and carry on? ISAs, remember that you have got till theoretically the 5th of April to invest money in a cash ISA or stocks and shares ISA. Remember that the 5th of April is actually Easter Day, so Good Friday isn't a banking day. That means you've only got till Thursday to invest in an ISA. So my suggestion is, if you're thinking of investing in an ISA, get down to the bank or building society or find yourself an ISA provider, do it straight away, today or tomorrow. In terms of how much you can invest, in each tax year, and the tax year runs from the 6th of April one year to the 5th of April the following year, in terms of how much you can invest, it's £15,000 for this tax year, 2014 to 15, or if you've got children under 16, you can invest up to £4,000 for them in a junior ISA. Remember then, that money's theirs, not yours, so you can't sort of put it aside and then take it out if you need it, even if it's for the child, it belongs to the child. In terms of why the tax year is such a funny date, do you think it'd be interesting to share that?
Yes, why not?
Why not indeed? Well, Britain used to use the Julian calendar, where the tax year and calendar year actually both started on the 25th of March, Lady Day, the date of the Annunciation of the birth of Jesus. Sometime in the 1700s, it switched to the Gregorian calendar, which we use now, laid down by Pope Gregory. But the Gregorian calendar was actually 11 days ahead of the Julian calendar, so they had to chop 11 days out of the calendar. And they also changed the calendar year to run from the 1st of January to the end of December, but the tax year was never changed. So that's why it's the 6th of April, because it's 11 days after Lady Day.
I see.
That's why it's such a weird day.
Fun fact for a Tuesday, guys.
Yes, indeed.
Excellent. So I think we are able to move on to our 5th and final tip. Although it looks as though Anthony, assuming this is the Anthony from the previous question, maybe let me know if you're not.
Oh no, I think it must have been a different Anthony, because this is a completely different question. And our Anthony is just
Anthony's everywhere.
Yes.
Okay, so here's Anthony's question. We deal with CIS as both a contractor and a subcontractor. When we pay on behalf of the subcontractor, it's easy enough and we have that sorted. but there is some confusion when it gets paid by a contractor for us. How do we go about exporting this data?
Okay, Anthony, it depends, honestly, if you're using free agent and the CIS is paid on your behalf, it would depend on how you're actually doing your books in free agent. What I would probably suggest you do is to drop an email to our support team, which is support@freeagent.com, so that they can give you a hand with your specific account and how you're handling CIS as a subcontractor yourself. If you're not using free agent, if your queries relating to how you get the data from the people you are subcontracting for, or how you get that from HMRC, the honest answer is, I don't know, but your contractor or HMRC might be able to help. I hope that's of some help, Anthony, and I'm sorry if that's not the answer you were hoping for.
Thank you, Em.
That's okay.
That is great.
Oh, we've had another one from Nicola.
We certainly have. So this is a follow-up. We will have to call him Anthony number 1. So this is a follow-up to Anthony number 1's question from Nicola. If your business is based at home, but you work in various other locations in both a regular and non-regular capacity, can you claim tax relief of travel in those instances?
Good question, Nicola. It is going to depend on exactly what you're doing at home and in all your different workplaces. It's going to depend as well on whether you're a sole trader or the director of a limited company. I'm afraid the rules are different because for employees, as in who are working through their own limited company, or employees of other businesses, like Jess and I are employees of Free Agent, the rules are actually different. It's actually not so easy. So you need to be a little bit careful. So if you're a sole trader, HMRC will look at where your base of operations is, and that might be an individual location, it might be your home, or it might be an area. So for example, a milkman's base of operations is where his milk round is. And it also depends on how often you're traveling to these different locations. So how much work are you doing there? What work are you doing there? It's actually quite a grey area. And when you're the director of a limited company, you can't actually claim for working at home unless you're doing what's called substantive duties there, things that actually earn you the money. So for example, I did some freelance screencasting because I used to do cutting and what have you at home. That was a workplace. But if I'd just been writing up my books, it wouldn't have counted. So the rules are hazy. I would probably suggest you check with your accountant to keep yourself right on that point, because there's no hard and fast answer.
Thanks, Em.
That's okay.
Hope that was of some help, Nicola. We've had a question from Reese. Thanks for your answer. You're very welcome, Reese. I do run a payroll for paying myself through Free Agent, and I came across the P11D there. My company tax year is not the same as this personal tax year. I will have to re-listen to your answer to make sure I understood correctly.
Okay, Reese. It doesn't actually matter what your company accounting year is in the context of the P11D or when you do your corporation tax returns. P11D is part of payroll, and it sounds like you've got a PAYE scheme set up. So if the company is reimbursing you expenses, or if you've got non-cash benefits like a company car, unless it's a mobile phone, which doesn't have to go on the P11D, if you've got expenses that you're being paid back for, or you're getting non-cash benefits, then yes, you are going to have to do a P11D. Unfortunately, you can't do that in Free Agent. Free Agent isn't equipped to do P11Ds. You would need to either ask your accountant to do it for you or find an alternative piece of software to do the P11D.
Okay, thanks, Em, and thanks,
okay.
Reese. Anthony, I think this is Anthony number 2. I'm so sorry if this is the same person. We do use Free Agent to record CIS, so I shall email in and ask. Many thanks for the answer.
That's a pleasure, Anthony.
Welcome. Okay, so I think we're ready to move on to Emily's 5th and final tip.
Indeed.
For preparing for the end of the tax year, and this is about gift aid, isn't it?
Yes, indeed, Jess. If you make donations to charity, you'll quite often be asked if you want to gift aid it. So think if you go to a stately home or something like that, you're quite often asked to fill in a form with your address and what have you to gift aid your donation. What that means is it's allowing the charity to claim back tax relief on your donation. The reason why you have to fill in your name and address is because you're declaring that you're a UK taxpayer, because you have to make sure you've paid enough tax through income tax for the charity to reclaim the tax relief. So if you haven't paid any income tax, you can't actually gift aid your donation. The charity is claiming back tax that you have paid. If you haven't paid the tax, there's nothing for the charity to claim back. So what's this got to do with the end of the tax year? What it's got to do with the end of the tax year is that if you are a higher rate taxpayer, so if you pay tax at 40% or higher, then you can actually get a bit of extra tax relief as well. So it's a good idea to make a note of all the donations you've made through the year under gift aid. Ideally, I suppose, do that as you go along, because otherwise you might find yourself going back through the calendar to find out, well, when did I go to that stately home, or when did I make that donation? For example, if you've made a donation to somebody who's taken part in a charity event, then you might well have a record of that. Have a look, make notes of everything, because you can actually put those on your tax return and get some tax relief if you're a high rate taxpayer. So make sure you've got your list ready to do your tax return. If you're thinking of making a donation sort of one side or other of the 5th of April, do it now, you'll get the tax relief sooner, so long as you've paid enough tax for the charity to claim the tax relief. Because I actually came across a situation in one case where there was a gentleman who was a non-taxpayer. He'd made donations and he'd gift aided them. Because he hadn't actually paid any tax, he actually had to then make that amount good to HMRC because the charity had reclaimed it. He declared when he made the gift aid donation that he had paid that tax, so the charity had gone ahead and made the reclaim. He hadn't paid any tax, so he actually had to make that amount good to HMRC, which isn't good.
No. Does he be making that mistake again?
No, he wouldn't. If you're in that situation, either don't gift aid it, or make sure that you've paid some tax, or be prepared to suck up the extra cost.
Wow. Interesting. Great. Thanks, Em. And am I right in thinking this tip and the previous tip about ISAs, this would apply to anybody regardless of when their accounting year end date is?
Correct, Jess. Yes, that's right. Whether you're sole trader, limited company, whether you have your own business or you don't have a business, whenever your accounting year end is, if you do have a business, the ISA and the gift aid timeline is this Sunday, the 5th of April. And obviously, as I say, because that's Easter Day, it means the Friday is not a banking day, so you've got one day fewer. So in essence, it's the 2nd of April this year that your deadline is.
Right.
Yeah.
Brilliant. Thank you so much.
That's all right.
We don't have any other questions to answer right now.
No, we don't.
Maybe a good thing to do would be just to give us a quick recap of those 5 top tips.
Certainly.
Please.
Yeah. Okay. So if your accounting year matches the tax year, and also actually for companies, if your accounting year matches the financial year, remember you've got a year end coming up too. So think about what you could do. Make sure if you're thinking of buying some equipment for your business, a new computer, some new furniture, a new car maybe, whatever it might be, if the business is buying some new equipment, make sure that you do that this side of your accounting year end and the tax year end, not the other, to make sure that you get the tax relief a year early. Make sure you've recorded all your costs, don't miss any out, otherwise you're going to pay too much tax. Make sure that you've included all your income at the right time. If you're using the cash basis, that's when you get paid for it, otherwise it's when you do the work. Make sure that you've invested all you want to up to the limit of 15,000 in an ISA before Thursday. Make sure that you've made a list of all the donations you made under gift aid in this year, tax year. Oh, we have another question from Phil.
We do.
He says,
Phil says, should we be expecting revised tax codes from HMRC, or should we contact them, and if so, when?
Hi Phil, I think what you're asking is new tax codes for the new tax year because the personal allowance will have changed. My understanding is that if you're on a standard tax code, so that's 1000L for 2014-15, my understanding is there's actually a standard process that you can follow to change your tax code to the standard tax code for next tax year, 2015-16. That should be on HMRC's website. Hopefully I'll be able to look that up for you and post it with the links that I'm hoping Jenny and Jess are going to post after this session.
Yes, absolutely.
Brilliant. So hopefully I'll be able to look that up for you, because there is, as I say, a standard conversion process for the standard code from one tax year to the next.
Thanks, Em.
That's all right.
Thanks, Phil. We have another question from Anthony 1.
Yeah.
He has one other question. There are 2 expenses that he seems to have misplaced his receipts for. Happens to us all, doesn't it? How can I claim for these expenses if I cannot locate the receipts?
Okay, Anthony. Well, what it's going to depend on is, have you got any other proof of making those payments? So, for example, you might have a bank statement, you might have a credit card statement. but do make a note of what it was you bought and when, because for example, it depends what the expense is. If you've got a cost on your bank statement that just says Tesco, then that might well be some box files for your business, or it might be your weekly shop. So see if you can demonstrate that was a purchase of box files. For example, if you can find the receipt for the weekly shop in the same week, or if you can show that was a one-off payment and that the weekly shop is a different amount on a different day, or whatever it may be. Basically what HMRC say is that if you lose records, you should make every attempt to try and recreate them. So think of what other alternative proof you could use. Just one warning, if you're registered for VAT, you cannot actually reclaim VAT without a receipt, without a VAT receipt, so watch out for that.
Okay, thanks, Em, and thanks, Anthony. We have a question from Gordon. If you have time, and I think we do.
I think we do.
Can you please explain a cash basis?
I certainly can, Gordon. Yes. Well, what this is it's a new simplified way of accounting that was introduced in April 2013. It's only available to sole traders and to partnerships whose partners are all individuals, so no limited companies amongst the partnerships. And it's only available if your turnover's under the VAT threshold. You don't have to be registered for VAT, but your turnover, or not be registered for VAT, but your turnover must be under the threshold, which at the moment is 81,000. That's going to change as of tomorrow and actually be 83,000. I hope I've got that number right. But in terms of the cash basis, what it means is that instead of recording your income and your costs when they were earned or incurred, you record them when the money changed hands. So for example, if you're preparing accounts to the 31st of March each year, you've done some work in March, your customer doesn't pay you till April, that income gets counted in April, not March, if you're on the cash basis. If you're not on the cash basis, it gets counted in March, because that's when you did the work. But remember that your costs also get accounted for when they're paid. Also, I mentioned in tip 1 about buying assets and capital allowances. When you're on the cash basis, you actually claim tax relief when you buy the asset and you put it as part of your running costs. You don't claim capital allowances. In actual fact, that's going to have the same effect nearly always, because most assets you get capital allowances at 100% anyway. The difference is cars, and those do get treated differently on the cash basis, and it is quite complicated. So if you're thinking of using the cash basis and you use your own car for business, I would check with your accountant whether it's going to be a good idea. Once you've elected to use the cash basis, you have to stay on it unless either you break the turnover limit or there's a genuine commercial reason for coming off it. And I very much doubt that HMRC would see saving tax as a genuine commercial reason. So just watch out for that. Once you've changed, you've got to stick with it.
Great, thanks, Em. Yeah, absolutely, and thank you for the question.
Yeah.
So we're coming towards the end of the session now. We've got another 2 and a bit minutes. So if you do have any more questions for Em, please pop them up.
I think Nicola's asked exactly the same thing as Gordon did. She said, what's the cash basis? So,
okay. And Nicola's a sole trader working for lots of different clients. I invoice for all work done at the end of each month for each client. Is that cash basis?
No, it's not, Nicola. That alone is not cash basis. Cash basis would be if you recorded that income in your accounts when your clients pay you. If you're using standard accounting or traditional accounting, you record that income when you do the work. So it sounds like you're still using the standard method, not cash basis.
Okay, great. Thanks, Em. And thanks, Nicola. Yeah, just a few final moments for any last questions you guys have.
Yeah.
So please pop them up if there's anything you'd still like to ask. So this webinar is part of a series of sessions that we run with Emily. So do look out on our Google+, Twitter and Facebook pages for news of our next one. We do sessions like this in front of the camera, and we also do other sessions where it's text-based on Facebook and Google+. So look out there for that. In terms of free agents, if you're not using free agent already and you're a small business owner or a freelancer, you'd like to give it a try, give us a visit at freeagent.com and you can sign up for a 30-day free trial and see how it could help your business there. If you are using free agents, you might be aware of our referral scheme, which is very good. So if you refer a friend, you both get 10% off your free agent subscription. Any other friend you refer after that, you get a further 10% off your subscription. So if you refer 10 friends, you actually get free agent for free.
You do indeed. Yes, so long as your friends stay as subscribers, you get free agent for free.
Absolutely. So that's something to look out for as well if you're a free agent customer.
Indeed.
I think we do have one final question from Sabin. I hope I'm pronouncing your name name correctly. We're in our first tax year as a limited company. We registered on the 8th of April 2014. Could you please shortly explain how we go about reporting to HMRC? As I understand, we have to actually do 2 reports for the first year.
Okay, well, the 2 reports for the first year says to me that you're asking about corporation tax. What that means is if your first company accounting year end is longer than 12 months, so if you set up your company on the 8th of April 2014, Companies House will have set you with a year end of the 30th of April 2015, that's your accounting year end. And yes, you will have to do 2 corporation tax returns for that first slightly long accounting year. The reason is that the corporation tax return can never cover more than 12 months, can't even be 12 months and a day. So what you'd have to do is do 2 corporation tax returns, assuming that you started the company trading as soon as you got it set up. The first one is going to cover a year from the date it incorporated, and the second one is going to cover that last little bit of April 2015. If your company didn't start trading straight away, your 2 corporation tax returns cover the bit up to you started trading, and then the remainder, assuming that the period till you started trading doesn't how to put this best. Assuming that you started trading on or after the 1st of May. Yep, on or after the 1st of May 2014. If you started trading before the 1st of May 2014, you could actually have 3 corporation tax returns to do. So say you set up the company on the 8th of April, started trading on the 20th of April, first accounting year end is the 30th of April the following year, you're actually going to have 3 tax returns to do, because you do 1 till you started trading, 1 for a year after that, 1 for the few days after that. In terms of what you report on each return, you don't actually have to work out which transaction was on which date. You apportion your income and your costs to the different periods. Apart from obviously any pre-trading period, that'll be nil across the board. Watch out for one thing though, the date on which you bought any assets. You do actually have to include those in the right period. So for example, if you bought a new piece of equipment on the 1st of May 2014, make sure that you put it in the company tax return that covers that date. Don't portion that. That's one thing to watch out for. But the first year is a little bit tricky when you're a company and you've got to do 2 or more tax returns. So do check with your accountant if you're not sure.
Lovely. Thank you, Em. And
okay.
Thanks for that question. And I think that brings us to the end of this lunchtime live session. Thank you so much for coming and for all your questions. Thank you, Emily, for your answers.
Thank you, Jess.
Oh, you're very welcome. Either I or Adrian, probably Adrian and Emily, will see you again very soon.
Great.
Thank you.
Thank you very much. Bye.